you don't keep moving, there's no way to hit the target. And so if you can just trudge one step further, then you haven't given up yet. And if you can do it one more day and you string a few of those together, you might get there. And that's really the only way that anyone ever has.
Welcome to the Build to Billions podcast, where we guide successful entrepreneurs and investors on their journey from millions to billions. We believe the key to scaling and compounding your wealth and life starts every single day with the mindset and practice of stewardship over ownership and applying billionaire biblical principles. Our ultimate goal is to help you scale and compound your wealth and life so you can give more all of it away to help MVPs, the most vulnerable people. My name is Brett Swartz. I am your host today. Each and every episode, we are joined by the world's best entrepreneurs, millionaires, and billionaires. They share their secrets, insights, and wisdom with us so we can all scale up and make a bigger impact. I'm excited about our next guest. He's out of the Miami area, and he specializes in M&A, exit planning, succession planning for his clients, mostly private families, using traditional mergers and acquisition services, plus ESOP buyouts, recapitalizations, and capital advisory. And he's going to share with us, in particular, ESOP strategies. And also, we're going to be touching on some different capital gains tax and ways to exit. Please welcome to the show with me the director at Butcher, Joseph & Co., Mr. Robert Reavis. Robert, how are you doing?
Doing great. Great to be with you.
Excellent. For our listeners to get to know you for the first time, would you give us a little more about your story and your current focus?
Yeah, so I've worked with Butcher Joseph now for over a decade. Our principal specialty is working with founders or closely held family businesses on succession planning. And we have a subspecialty in this interesting framework called a employee stock ownership plan, or an ESOP, which I'm really excited to get the opportunity to speak with you a little bit more on today.
Excellent. Let's dive right into that. What's the number one secret to setting up a proper ESOP so that your employees win and you win as the owner of the company?
Number one secret, as really with all succession planning, is putting in place a lot of thought, a lot of careful analysis, and a good team as early as you can, so that you know what your plan is, you know what your objectives are, and you know who you need in order to execute on your plan. And putting that together early and giving yourself enough time to think through the structure and to plan those years in advance, both pre and post transaction, is the key to making sure that several years on, transaction value is sitting where you want it to be, which ultimately is with you and with your company.
Excellent. So that makes sense. So being early and being thoughtful, being intentional, and the better, more you can do that, the better. S-Corp, C-Corp, LLC, for ESOPs, is one better than the other?
Depends on what your objectives are. The way that the regulations are currently structured, if you sell stock in your business over 30% that you've held for more than a year to a C-Corp ESOP, then you have the optionality to defer capital gains using a structure called 1042. And what 1042 does is it's very similar to a 1031 exchange in real estate. You're allowed to buy qualifying replacement property, typically public US corporate debt or public equity. And you then have the option to further leverage that to get liquidity and to hold on to that qualifying replacement property until the resolution of your estate plan, at which point, oftentimes, heirs will get a full step up in basis and allow you to ultimately defer and avoid the capital gains tax. Now, I will add very quickly that we are not tax advisors, and those are very general concepts regarding the process, but that's kind of the overall structure and how it works. Now, if you sell to an S-Corp, you do not get the benefit of the 1042 deferral, but if the company is 100% S-Corp owned ESOP, then it is entirely exempt from ordinary income, business income tax, or personal income tax. In the C corporation scenario, you have a number of really important ongoing tax advantages, but there is a potential for some tax leakage depending on the way that the company is structured and whether or not it has a natural tax shield and a number of other factors. Ultimately, it's really important for owners to sit down with an advisor and run several different scenarios so that they can see what the benefits are and whether or not they are good candidates. Typically speaking, if you're a C corporation today, there can be a lot of benefit to executing the transaction as a C corporation and then converting to an S. If you're an S today, you need to do a little bit more careful tax planning with your CPA and with your banking advisors in order to make sure that the transaction aligns with your objectives.
Okay, that was awesome. Thank you for that. And by the way, people want to learn more about Mr. Robert Reavis. He's with Butcher and Joseph and Co. You can go to butcherjoseph.com, butcherjoseph.com. So make sure I capture that. You have to follow some rules, right? And some things, right? And in order to do that, and I'm just pulling up some general stuff, what you said, it's section 1042 of the Internal Revenue Code allows owners of closely held C Corps to sell stock to an employee stock ownership plan, ESOP, or an eligible worker-owned corporate cooperative without immediately recognizing capital gains. So it's a way to defer taxes like a 1031 exchange for real estate, which has to be investment real estate, but you can do that for business as long as you're following these certain guidelines, Robert, which is what you help people to do, which I think requirements
Correct.
at least 30% of the company stock must be sold to an ESOP, right? My next question is how long does it take to sell typically 30% of a company's stock? Let's say my company's worth $30 million and I'm like, this sounds cool, but I have an offer on the table, Robert, and man, I want to take advantage of this seller or this buyer who's willing to buy. Are these things that it can be set up in a few months or 6 months or a year? How long does it typically take?
Well, and you'll get tired of hearing this. It ultimately depends a lot on your objectives. A typical ESOP transaction probably takes 5 to 7 months. If you are looking for liquidity as part of the transaction, which typically involves an outside capital raise, that's where you get to kind of your 6, 7 month mark. If you are looking to execute a transaction solely using a seller note, then it can be executed, in several months, depending on what the state of your financials are and whether or not you have a pre-existing banking relationship and things like that. On the other hand, one of the things that can be really useful if you've received an offer, a market offer, is that will inform, it won't necessarily set the value that you would transact at with the ESOP, but it will certainly help inform it. And so when you think about what you're going to get out of the transaction on a post-tax basis, if you were to take advantage of the deferral, you might find that ultimately you ended up significantly ahead, even though you would have to wait a little bit longer. Now, in a 30% in a minority sale transaction, you could get very comparable liquidity from what you would get selling the same amount to a private equity company or to a strategic buyer. It's really in the 100% sale case that the differential in liquidity at close becomes most pronounced. In other words, 100% ESOP sale requires some seller financing, and you may not have as much of that if you sell to a private equity company or a strategic.
Got it. It all depends, which is good. I mean, that's part of why you hire the Robert and the Butcher and Joseph to do all this stuff to get you all set up. So let's take another step back. The advantage of the ESOP, obviously the employee's advantage, right? They're more likely to stay longer. You're going to attract and retain better talent, which is going to ultimately help the company succeed. And it's a chance for you to bless those that are working so hard for you, right? On that side, what else would you add to that besides being eligible now for 1042 for the seller side that I haven't touched on those?
Well, I would say that oftentimes sellers who are interested in the ESOP start exactly as you mentioned from a standpoint of desiring to deliver a benefit to employees who are or have been helping them to create value and who over the years have given a lot of service to the business and who you wish to reward. Another thing that can be really important for sellers is the maintenance of culture and the ability to put in place a management team and a board that will ultimately protect the legacy of the business. In a majority sale, which I would say is probably most of the work that we do, the ESOP is one of the kind of incremental advantages is that the ESOP is a perpetual investor. There's no artificial pressure to sell the business at any point in the future. which means that the business can focus on strategic objectives. It can focus on growth. It can focus on employee development without needing to hit an artificial private equity 5 to 7 year timeline, which is something that also really appeals to sellers who don't want to create a lot of disruption for the business as soon as they leave, which is probably much more likely in the case of a strategic or financial buyer.
Okay, interesting. Let's keep going here. So now I set this up. I do the 1042. You help me sell my company for a great price, right? You negotiate that. You said the funds go into like kind. So if I'm selling out of a C Corp, you mentioned some securities. Can it go into real estate? Can it go into Bitcoin? Can it go into stock sponsors? Like, is it specific? What are the limitations for where can it invest?
Well, so for the like kind exchange, you are typically going to buy public debt or public equities. But what you can do, and what some large investment banks like a JP Morgan will do for you, is they will actually structure a note, long dated, with a floating rate that will ultimately align with your projected estate plan. And then you can effectively get liquidity for that note, which you hold as an asset, and which allows you to then invest in other things, use for consumption, and then you unwind the structure at the time of your death and as your estate plan is being executed. So it's not necessarily a question of what asset you buy immediately, which has statutory requirements, but then what you do with that structure in order to meet your liquidity objectives.
Okay, so let's walk through that for a second. That sounds pretty cool. So, what's the note interest rate on average? What's the loan to value on average?
Well,
Let's say it's a $100 million exit, right? And I've got this all set up. What can I spend that money on personal stuff when I leverage against it? Does that have to go into investments, or what's the flexibility there?
no, I mean, once you have ultimately leveraged your qualifying replacement property, you basically have an ongoing cost versus the ongoing cost of the note versus the ongoing interest income. And then ultimately, there are no restrictions on what you would use that liquidity for. Now, depending on the underlying asset, the loan to value can be different. But I would say that in many cases, the alignment between the note value and the underlying asset are pretty close. Maybe 10% at each leverage differential, 20, depending once again on how perfectly you're able to align your underlying asset with your note.
Okay, so interesting. So the note kind of typically mirrors the investment allocation percentage return, and then the LTV though. So what percentage do you typically see for how much against it?
That's what I mean when I say that
Oh,
it's a pretty broad range, and it depends on, again, what that underlying asset is.
okay,
But it can be, I don't know, it can be probably over 80%,
okay,
sometimes higher.
okay,
Now, what I will say is that typically there is a carrying cost
right,
because the underlying asset's not generating the income that is equal to what you are being charged for the note, but you
correct.
can get them pretty close. And you can certainly do a present value calculation to see what the implied value of the tax savings would be. It's generally not a difficult calculation to show that the carrying cost is a superior election.
Yeah, no, that makes sense. I'm just thinking of the ability to service the note, right? If I borrow 80%, what am I investing in there to make sure that I'm servicing? And if I don't, what, kind of like a margin call, what happens? And then, does the whole thing kind of collapse on itself? And you'll be smart about the amount of, debt that you're taking on. It's just kind of thinking strategy there. Any strategy on that, Robert?
Yeah, I would say that you would ultimately be as strategic there as you would be with your portfolio in general. In other words, you would keep some cash reserves in order to make sure that you could always service the note, which is the important part.
Mm.
Again, the differential is not typically huge between the interest that you're paying and the interest that your underlying asset is generating. But of course, you would want to make sure that you had cash reserves, just as you would in any prudent portfolio. I would also say that typically speaking, what our sellers are doing is they're then using that liquidity to buy other assets. And so what they're finding is that the investment portfolio, including your qualifying replacement property and then what you're using it for subsequently, is dramatically outperforming the cost of the underlying note.
Okay.
You're buying an asset that's intended to be sufficiently stable that there is very little risk of, I think you mentioned the margin call. You're not buying a highly volatile underlying asset.
Mm-hmm.
The intent is that there's very little movement in the underlying value, which would ever cause the bank to, make a margin call, as you say.
It makes sense. You mentioned is it corporate bonds, and you mentioned those two. Like, what are the average returns the last 10 years? I'm wondering on those.
Well, obviously, it depends, but if you're using corporate bonds as your qualifying replacement asset, you want them to be long dated and you want them to be as secure as possible. So you might be looking at anything from 3.5 to 5.5.
Okay. Okay. Excellent.
Now, obviously, interest rates have gone up significantly in the last few years. And
Mm-hmm.
so there's been a little bit of a differential that's opened up. But a good rule of thumb would be to say that, if you were buying a AAA rated bond from US corporate, you'd be looking at maybe 50 to 200 basis points above the treasury, probably on the lower end of that, depending on the company and the
Yeah.
underlying dynamics of the industry.
Yeah, that is helpful. Let's shift a little bit into just when you're helping people exit non-ESOP, right? So the other maybe 50% of the deals you're helping people with. What have you found for exit strategies with capital gains tax? Besides the seller carryback, right, which has some inherent challenges because you might have to take the business back, and you're not liquid, you're not diversified for that amount, and I think a lot of sellers, especially families, if they're ready to move on, they're not wanting to have to pick up the pieces if the buyer doesn't work out in a couple of years, right? So, for those who do not have C-Corps, do not have an ESOP, right? And they sell a 10, 20, $100 million business. What's been your go-to, or any thoughts on that?
Are you saying if they're not selling to an ESOP, so in a
Not
traditional
selling
sale?
to ESOP, it's just kind of a traditional sale. They'll say they're an S-Corp, right? And then they just have massive capital gains tax. And they're like, hey, Robert, like, I don't either have the time to do an ESOP, nor do I, or want to, or whatever. I just want to be done. And now they're, about to get hit with tax. I have one to propose to you, but I'm just kind of curious what you've used in the past.
Honestly, again, we are not tax strategists, and so we really can't speak to that as effectively as I'd like to. I would say that in those instances where you are selling the company using any kind of seller financing, or potentially where there's some kind of hurdle that would allow the private equity company to buy incremental percentages of the company, depending on how much you sell at the close, there may be some optionality around taking installment sale treatment on the gains, or I'm sorry, on the sale as that's realized. But again, really not a tax specialist.
Okay, cool. I'm going to propose one to you, and I know you're not a tax professional, and not like offering tax legal advice, but this is what we do. Like, we're doing one right now. It's a nearly a $40 million exit for a client out of Arizona, and it's an S-Corp, and they're selling their business at zero debt, zero basis, and so we build basically a seller carry 453 installment sale method with a trust, and combine those two. So you get the upside of deferral, but none of the downside of a traditional seller carry, which is illiquid, not diversified, tied to the old business. I might have to take it back. Funds hit Charles Schwab, buyer takes title the normal way they would, and the seller just gets typically a note for 8, 9, or 10% or so, and they get paid back in installments over time. But the cool part is they can invest into whatever they want, Bitcoin, stocks, real estate. They can go back into their other business ventures by partnering with the trust, which I think is pretty powerful. One of the downsides is if you take personal payments, you pay tax on that, but we get to defer 100% of the capital gains tax as long as there's no debt over basis at closing. And done it a couple thousand times with my business partner. I mean, he has, and I was younger at the time, but CPA, tax attorney, all that stuff. He was a former M&A attorney for Fortune 100 companies, so he figured it out. And so this is what we do. We build capital gains tax exit plans for those that don't have, QSBS, don't have a good 1031 lined up, right? Don't have now the ESOPs, and they're looking for flexibility to be an entrepreneur, to defer the tax, to go through all that. So have you ever heard anything like that before? I'm just kind of curious.
No, I would say once again, the tax planning is a little bit to the side of what we do. It sounds like a great, very interesting strategy, but we typically will partner with a CPA firm and a legal tax team
Yeah.
to help us structure those. What you find is that in general, these business owners have already in place highly complex succession planning.
Mhm.
And so building your plan around what's already in place and what their
Mhm.
objectives are, every situation is so different. But it sounds like a really interesting strategy.
Yeah, simply, if you want to learn more about it, you can go to capitalgainstaxsolutions.com. In fact, we wrote a book on it called Building a Capital Gains Tax Exit Plan with Kevin Harrington from Shark Tank. You can look at that on Amazon. And yeah, it's our passion and our focus. I started out and Marcus and Millichap helping people buy and sell multifamily properties and doing 1031s and the '08 crash, Robert, everything hit the fan. And we said, there's got to be a better way than just 1031 where you're just selling high and buying higher 180 days later, no diversification, no liquidity, having to go to equal greater debt. And this is when we learn about this strategy. And I'm going, wow, it works for businesses, works for Bitcoin, real estate. People know about it. It gives them lots of flexibility. Again, go to capitalgainstaxsolutions.com. And by the way, yeah, my business partner is a CPA and a tax attorney at the law firm. So he is that. But I find a lot of the other ones we compete against, they're just not as flexible. They require maybe more charity than someone wants to give. They have to buy a bunch of life insurance. They require the gifting. Ours does not require any of those. And the other piece about this, Robert, too, the big one that I think people miss is the estate tax, right? It's about 30 million per married couple now, 15 million single, but the estate tax is massive. And stepped up basis doesn't solve for that. You can either have a stepped up basis or outside your taxable estate, but you can't have both. So we have a 2.0 version of what we do. It eliminates the estate tax. And again, I know you're not a tax professional, but estate tax, I feel like, is the big elephant in the room, that this 100 trillion that's transferring the next 5 to 15 years from the baby boomers, that if it's not solved for, they're going to get crushed. And the stewardship of that capital is vital. I also think as an M&A advisor, if you can solve the problem that they can't solve, you're more likely to get the listing to do the deal. In other words, you say, hey, hold on to the $130 million business. Your 30 million is exempt, but your other 100 million is subject to a $40 million estate tax. And so it's the whole Mr. What's it, Yellowstone, right? Kevin Costner. And Beth is like, Dad, you got to sell it. He's like, I'm never selling the land. He's like, but Dad, if you don't sell the land and you die, estate tax is going to take it anyways. He's like, I'm not selling the land. It's like, well, you've got to, because the government wants to crush that. So any thoughts on the estate tax challenge?
What I would say that is relevant in this discussion, and especially with respect to the way that we finance these transactions, is that typically speaking, in 100% sale to an ESOP, but occasionally, in other contexts, a seller note will be issued for the portion that's not being financed with third-party debt. And attached to that seller note often are what are called warrants. And if you think about an ESOP transaction, a typical 100% leverage ESOP transaction, on the day after close, it's like buying a house with 100% debt, both from the bank and maybe from the seller. So in order to compensate the seller for being that deep in the capital stack, the transaction will allow them to take on what are called the warrants. And so as the company develops equity value, those warrants begin to have value, and they're valued each year. Now, what we have seen some of our sellers do is work with their estate plan to gift those warrants at the time that they have almost no value. It would fall under your lifetime gift exemption, as I understand it. And then ultimately, as they accrue in value, a significant amount of value could have been transferred without creating a big, reduction in your lifetime gift exemption.
Awesome.
But
yeah, by the way, I love it. By the way, Robert's not paying tax legal. Check with your CPA and tax attorney, but these are some things that he has seen done. And if you're interested in learning about our strategies to capital gains tax, go to capitalgainstaxsolutions.com to apply for a no-cost consultation. So I think it's so fascinating because I think tax flow versus cash flow, most people focus on cash flow, EBITDA, sales price, but they don't spend as much time planning for the massive tax, not just the cap gains tax, which, depending on what state you're in, you're paying, 20 to 50% with depreciation recapture. And I've seen C-Corps as high as in California. We did a proposal. He was going to pay 67%. I mean, it had been in the family for 40 years and the whole thing, like it was going to get crushed. It was like a car dealership. Right. And so So you've got to get your tax flow, capital gains tax planning, estate tax planning prior to everything selling, right? Be early, be early, be early, like everything we're saying here. And I know everyone's thinking, they might be thinking, I'm not going to sell. I'm not going to sell for a long time, but it can come faster than you think. Death, divorce, partnership breakups, things can change quickly. So the more you can plan, the better you can be in a good shape. Robert, that being said, are you ready for the lightning round?
I'm ready. Let's
All right.
try.
Now what you know now, if you go back to your 20-year-old self, what's the one golden nugget? Make sure to tell yourself to do.
If I were to go back to my 28-year-old self, I would tell myself to check the numbers one more time because you can never be too sure. And I would give that advice to every other 28-year-old out there, particularly in this space. Precision is really important. And so check it one more time. Make sure that you understand it and make sure you could communicate it to someone if you needed to.
I love it. Next question. Number one book you've recommended or gifted the most in the past year?
I would say that the most kind of mind-bending or interesting book that I've read in the last few years was The Black Swan by Nassim Nicholas Taleb, and thinking about the way that uncertainty plays an enormous role in life. And we tend to kind of plan around it as though it's not there, but really leaning into it and using it as part of your plan can be a critical factor in, achieving your success.
I love it.
It can also derail you.
I love it. By the way, I think about the Black Swan group. Chris Voss also came to mind. Have you studied the negotiation and the communication training with the Black Swan group?
No.
He was the FEI negotiator. If you heard of this guy, and if you haven't, he's amazing. Check him on YouTube. He's got a book called "Never Split the Difference," and
Yes.
he would negotiate high stakes, basically hostage situations to help them get released, and then he applies it to business and owners and negotiating. It is the best I've ever training I've ever received. He's got this master class that you can take if you have master class, and you can watch it, and it uses mirroring and labeling. It uses it uses basically dynamic deep listening and then ways to find win-win situations, right? Versus just splitting the difference. Like it's so good. It's so good. So if people haven't seen that, check out Chris Voss, Voss, Never Split the Difference. You maybe think about that, but I'm also going to check out that book. That's cool. Next question. What are you most curious about right now?
Well, I'm learning Spanish right now, so I would say I'm most curious about Spanish grammar at the moment, but I wouldn't necessarily encourage everyone to dive into that unless they had a particular interest. I'm also a big history buff, and so I realized that my grounding in history really starts in like 1492 for some reason, both in European history and in American history, but I have very little grasp of what happened between the fall of the Roman Empire and the reunification of Spain. And getting a little bit better handle on that is something that I've set as a personal goal, and I've got 3 months left in the year. So
excellent. I love it. Next question. Number one way you're using Chat GPT.
we've started to use it in all kinds of ways. I use it a lot for grammar check. I use it a lot to give me research ideas. I use it a lot to think about changes that are occurring in industries that I'm working. We use it also to help us look for transactions that have just occurred in our industry. We look for questions that we should be asking about an industry that maybe we haven't thought of. So I would say that we're using it in almost every part of the work that we do, while keeping an eye on the fact that it still has that occasional tendency to hallucinate. So you got to check its work.
Excellent. Yeah. Check your numbers. Check your Chat GPT. Next question, and then we'll have one more, and then we'll wrap it up. Number one leadership quote and or theme that you strive to live by.
My favorite is what could possibly be a fallacious Winston Churchill quote, that to just keep buggering on, just don't give up. Keep, if you don't keep moving, there's no way to hit the target. And so if you can just trudge one step further, then you haven't given up yet. And if you can do it one more day and you string a few of those together, you might get there. And that's really the only way that anyone ever has.
I love it, Robert. That's fantastic. And very last question, then we'll wrap it up. And then we can remind listeners where to find you. So after all your success, helping all of the clients that you've served, how do you best keep a stewardship mindset over ownership, right? And then what's something you're really passionate about, giving away to make a difference?
One of the things that I have found is that the vast majority of business owners that we work with who are interested in succession planning already have a stewardship mentality. And the most important part of the transaction is making sure that after we're done, that legacy endures at the business. And that's something you do by having great people below you, great managers, and great succession leadership programs. And then in terms of, maybe a cause or something I'm interested in advancing, started working with a really great charity called the Beagle Rescue Project. I have a great little beagle, and there's a lot of pretty unethical testing that is done on animals too much in the United States, really just for silly things like products that we use around the house. And working with them to kind of tighten up legislation and to care for animals that have been mistreated in those programs is something that I've gotten really involved in and I've really enjoyed working with.
Robert Reavis, it's been more than a pleasure to have you on the show. Tons of wisdom that we've covered here in the past, 30 or so minutes. I want to thank you for sharing that wisdom and geeking out with me a little bit about some tax stuff. And really, I want to encourage you to keep doing what you're doing to make a big difference in people's lives. When they exit, help them steward the capital in a great way, get a great price and a great win-win for all the teams below them using ESOPs. For our listeners who want to get in touch with you, one last time, what's the best place for them to find you?
You can go to butcherjoseph.com and you'll have all my contact information there. Go and click through. We've got some great white papers, and we also offer kind of a free transaction feasibility product for people who are interested in seeing what their business is worth and what their options might be if they're at that early stage or they're a little bit closer to transacting. It's a great place to start.
Awesome. Thank you, Robert. And thank you, all the listeners and our viewers on the YouTube channel for the Build It to Billions podcast and the Capital Gains Tax Solutions podcast. Yes, we're dual streaming on both of those channels. We're on this journey with you to scale from millions to billions so we can get more all the way to help MVPs, the most vulnerable people. I'm Brett Swartz. I want to encourage you to take action today. Share this with someone it can make a difference for. It can make a difference for their employees, right? And then they could sell for maybe a higher price with Robert to make a huge impact for their family as well. And of course, if you have other massive capital gains tax and estate tax challenges and you want to explore what we offer here at Capital Gains Tax Solutions, go to capitalgainstaxsolutions.com. Appreciate you watching or listening, and we will talk to you again all real soon. Bye now.